There's no shortage of risks to focus on between the U.S.-China trade tensions, a continuing U.S. government shutdown, and now concerns about credit. Brad Simpson, Chief Wealth Strategist with TD Wealth, joins us now. And Brad, how should investors be thinking about these risks and the jolt of volatility that we've seen so far?
Yeah, I guess maybe the starting point is that, if we went back and replayed a few of my interviews over the last few months, the starting point was, I think when I was here in September, I said, we have, on average, most of the time, you go through the summer and markets become very illiquid, they become very quiet, and we had unbelievably low volatility in the summer. Then, of course, you walk into the fall, and and I think we could all agree that September turned out to be a pretty nice month. And so here we are in October. You kind of get these shades of October a little bit, and when I've heard when I hear about volatility, and we certainly have some volatility in fixed income markets right now, I want to give this a little bit of context. I was reading an article by one of my competitors the other day that says that on Friday the market crash, it was down 2.5%. It's like, what? Let's hit the brakes here a little bit and say that let's look at the credit space as a starting point. We have spreads between government bonds, investment grade bonds, and high yield bonds at all-time lows. Okay, so we're saying is your difference between of what you're going to get from a government down to a high yield, and the tightness between them shows that in credit markets there was almost no perceived risk. When you get to that point, so credit spreads are where they were before the great financial crisis. And so you get to that spot, you start looking for any sort of volatility that is going to break out. And because it's priced for absolute perfection, we have had a significant infusion of capital into the private space. In the last 5 years, the growth of investment in that environment, which moved from the public market into the private market, and in that move is one thing that we've talked to an awful lot of our clients about, is saying that if you're allocating, and we think allocating in the private space makes a lot of sense, who are you allocating with, and the value of who you're investing with. And what you're looking for is you make sure that you're not investing this with folks who aren't very clear on the risk management side. There has been some loosening of standards in this proliferation between public and private that's been going on, and we're seeing some of this right now in the credit space, and we're seeing this move out. At the end of the day, we're not talking about credit contagion right now. We don't see credit contagion right now. What we see is in the public space, a lot of orderly transactions going on in the investment grade space. When we're looking at the high yield, once you get to close where we are here, and you get back to that barometer of kind of an 8% coupon in high yield, that even through the great financial crisis, if you were writing that out, it actually worked out okay. And we don't think we're in the early stages of an environment like this one. We think we're in a market that really does need a little bit of a correction in the credit side of the equation.
Okay, so given that backdrop, how should investors be thinking about their portfolios, in this environment?
I think that the most important thing that people should be thinking about here is that if there are anywhere in your portfolio that you're invested on the extremes, because what happens is that, we have gone through this incredible risk market rally. And so what happens is, you have a little bit of your money allocated into more risk or part of the market, then you have some more, and you have some more, and you have some more. And so I would think that what I would think is to look at anywhere in your portfolio where you are overextended, that you've allocated into where you've over allocated into anywhere where you've taken a decision on the extremes. This is not an environment to be in the extremes. This is an environment where the way we allocate, as we say, we have our strategic allocation that we're set, and then we'll look at it. So we'll say, here's how we're allocated in fixed income right now. Our strategic asset allocation, we are underweight that right now. We're underweight that right now with areas. We think in a credit environment where things are so tight that it's an environment where you don't want to be overextended. In the equity market right now in the U.S., we continue to be overweight, which does tell you something of a vote of confidence in that now. However, if you've been running your whole portfolio in the big tech trade or in the Mag 7 side of the equation, we think that's an environment where you should be pulling back and really and looking at it in those terms, making sure that you're using hedging strategies. We think that this is an excellent environment for long, short, and market neutral strategies as well. And so we would definitely be deploying capital in there. And I think if you're doing that, and being mindful of, this is not volatility we're seeing right now, right? This is small cap volatility. When I hear people talking about it, it's like all cap volatility. I think we have to remember what that looks like, and our memories are short.